Hey everybody, Chuck Barone here. It is Thursday, August 17th, 2023, and another day of crazy to talk about today. I'm telling you guys, this is one of the weirdest economic environments I've ever seen, with so many mixed signals and so many different views on where things are and where they're headed. Crazy times, man. But anyway, before I get rolling, as always, let me welcome everybody to the show. Nice to have you guys here, and thank you as always for your support. You guys keeping coming back, watching these videos, hanging in there with us, actually following our advice, hopefully. This is what keeps us coming back every day doing this stuff. We appreciate you guys and your support. All right, so let's talk about these markets today. Crazy day in these markets. The stock market, unhappy with higher interest rates, as it has been for the past week or so. The Dow down 290 points today, 34,474 on the Dow. The S&P down 33 points today, 4,370 points, or 4,370 on the S&P 500. The NASDAQ down 157 points, 13,316 on the NASDAQ. So the markets continue their slide. Not really happy with the way rates are spiking, especially longer term rates. So, and I don't really see much of, and we'll see how long this lasts. But the stock market was always finding reasons to go up, now finding reasons to go down. The bond markets today, well, kind of another weird day in the bond market. Just the weirdest phenomenon happening. So you got a 10-year today jumping 5 basis points, sitting at 4.31%, a big number on the 10-year. The 2-year at the same time dropping 4 basis points, 4.94% on the 2-year Treasury. So as you can see, the inversion shrinking. Right now we're down to, what is it, 63 basis points. It was up around 115 or maybe more in the past. So this narrowing now, it's going to be fascinating to see how much more this can go. Is the yield curve in the process of getting out of this inversion and reverting back to the normal? We'll see, guys, but this 10-year, this high number on the 10-year, not boding well. People wondering why rates are spiking when it seems like the Fed is, well, at least the market says the Fed is done raising rates. How about the U.S. government in the Treasury market for $1 trillion friggin' dollars this quarter? And guess what? Another $800 billion coming next quarter. And we're talking, trillions and trillions of dollars here. Well, that's going to drive rates up, especially since these auctions have not been, what's the right word, oversubscribed, right? So the bond market pointing in a really weird direction here, showing uncertainty like everybody else. The dollar today down just fractionally, sitting at 103.41 on the index. Still the strongest, not much to report. Strong dollar, of course, putting pressure on precious metals. Gold down today again, down $2.40, $1,889 for an ounce of gold. Silver at the same time gaining 28 cents today, $22.66 for an ounce of silver. So there you have it, man. Metal struggling right now with this strong dollar and a lot of economic uncertainty. I really think silver is the play right here. Super cheap price. People, for a couple $100, you can get yourself 10 ounces of silver. That's something that most people can afford. Put some away. We've already been advising, 10 to 15% of your portfolio in gold and silver. If you guys have been following that, you've done pretty well over this past year. Not so great over this past month, however. Oil today, up small, up 70 cents a barrel, breaking back above $80, $80.08 for a barrel of West Texas Intermediate. Looks like oil is back down, on its way back down to the trough at 70 to 75. We're going to watch this, but if I'm a betting man, I'm thinking oil ends up there before too long. Bitcoin today, not a good day for Bitcoin, down $1,245. A big dump on Bitcoin today. 27,857 for Bitcoin. Amazing, yesterday was sitting over 29,000. What a difference a day makes, man. But Bitcoin, I still feeling a little bit optimistic on Bitcoin. I think if these ETFs come into fruition, which it's likely they will, considering the players pushing these ETFs, I think you're going to get a big jump in Bitcoin. So this might be an opportunity, if this year's so inclined, to buy a little bit. All right, let's look at news you guys need today. We knew today was going to be a big dump day on data. We got all kind of stuff to talk about. Unemployment leads the way as always, coming in at 239,000 this week versus 250,000 last week. They were expecting 240,000, so basically right on projection, a little under. Job market's still very, very resilient. Now, I know a lot of people watching this show doubt these numbers, and we know I have to take them with a grain of salt myself. But these are the numbers that are being reported, which I then report to you. They are the numbers we do get to go by, unfortunately. It's showing if you want a job, it's likely you can get one. Earnings for employees continuing to grow, up 4.4% year over year. So earnings continuing to go up. As we all know, this is the Fed's number one target, the number one reason that's left now that these supply chain issues have kind of straightening out a little bit. The number one issue the Fed sees driving this inflation. They've been railing against it for a long time. They want it, they want this number higher, and they're likely sooner or later going to get it. So employment still continuing hot. Leading indicator report today falling for the 16th straight month, falling basically a half a point since just last month. Now there's 10 components that go into this leading indicator that they look at, okay? So they can measure an overall idea on where the economy is and where it's going. The 10 components are, number one, average weekly hours worked. 2, average weekly jobless claims. 3, manufacturing new orders. 4, ISM index. 5, new orders. 6, building permits. 7, S&P 500. 8, the leading credit index. 9, interest rate, spread between the 10-year and the Fed funds rate. And number 10, consumer sentiment index. So here you have it, the leading indicator falling for 16th consecutive month. 7 of these 10 down. Everybody's talking about this perfect soft landing. Leading indicators aren't saying so. Now 16 straight months down. Chances are we should be in a recession by now. We're not. I'm not so sure exactly what is holding this economy together at this point. It doesn't seem to be great. Well, we'll see. We'll see where this all continues to go. But these numbers, again, completely confusing. Jobs showing the economy strong, leading indicators showing the economy not so strong. Which do you put more weight on? Fed releases their minutes. Didn't get a chance to talk about this yesterday. Not the greatest report the Fed releasing. They're talking about further progress. This is a quoting. Further progress toward balancing of supply and demand in the labor market is needed. What's that telling us? They want jobs, unemployment numbers higher. They said the economy was expected to slow and unemployment to rise somewhat. Okay, well, we got 3.5% unemployment right now, historic lows. Let's see what somewhat means. They're still expecting the economy to slow. Wall Street expecting it to continue to grow. If you look at the Atlanta GDP Now tracker, wow, it's showing 5.8% projection for third quarter growth. Well, that would be just something amazing to see. I really believe that if that is anywhere remotely close to the truth, well, we're probably going to get more than the one rate hike I'm telling everybody we're going to get before this year's out, likely more. Couple of quick hits today. You guys are going to hear more and more about this soft landing nonsense. I'm telling you guys, I've never seen it actually done. Right? Now, I guess the 4-minute mile, it's possible that it can be done. I just have never seen it done exactly. So you're going to hear more and more and more about that. I tell you now, keep your powder dry. if the soft landing does happen and you have some extra money put away, you're not going to be but worse off for that. Okay, so remember, soft landing, in my mind, highly unlikely. Another quick one today, mortgage rates spiking up again over 7%. The highest rate on mortgages now in 21 years. We're going back to .com era times. Not good, man. This is really tough with these higher prices, the squeeze on inventory, nothing there to buy, supporting these higher prices. I don't know, man. They're talking about mortgage rates might even have to go as high as 8% before the Fed's done. If that happens, man, look out below in real estate, guys. There's going to be nothing left of it. 7% already is incredibly hard. You talk to a client sitting across your desk who's interested in buying a house, and you mention an interest rate at 7%. Let's just say it's not the most fun conversation to have with clients, right? Commercial real estate, another quickie here. Commercial real estate continuing to loom on the economy and the banking sector. Big stuff coming with that. There's tons of stuff that needs to be rolled over. Major real estate investors just handing back the keys, not even trying to redo these loans. We're going to see a big spike in foreclosures. We're going to see a lot of pressure on regional banks who own the majority of this paper. We know we have trillions of dollars of commercial real estate coming due. Those loans need to be redone. But imagine this, okay? You're a commercial real estate holder. You own a plaza or an apartment complex or whatever it is. Apartment complex probably not so bad, but like anything to do with retail, like shopping centers, malls, and that kind of stuff, those guys are getting hammered, man. Their property value's in half. Now you're looking at having to refinance a gigantic loan on that property, and you get to pay twice in interest what you did the last time you had to redo the loan. Impossible to happen. It's just not going to happen. So commercial real estate and the collapse of it looming large, in your humble host's opinion. I got to tell you guys, here's a few things. I call this Chuck Says, because Chuck's saying, I'm telling you there's going to be one more rate hike this year. I really believe. Probably in September. If we have to wait till October, November meetings, so be it. Going to happen at least one more time this year. On top of that, I say to you, look out below if we have a spike in inflation. Now, this idea that inflation is going to go straight down, we had a little blip up this past month, right? Going from 3 to 3.2. What if it would have been 4.2? What do you think the reaction to that would have been? And I'm telling you, something like that is not completely out of bounds. Now, the Fed wants a recession. That's what they've been aiming for with all these interest rate hikes. They're likely to get one. I believe real estate will lead this recession, with both commercial and residential leading the way. Tough markets for both right now. Expect big doings in the banking sector. Commercial real estate especially is going to put a ton of pressure on regional banks. You got Fitch looming with their downgrades, all kind of stuff happening that's not so great. Government going to be involved in this bailout, or who knows what the hell, how it's going to play out, but the government will be involved, which is never, ever, ever good stuff. And then you got the factor of, at the end of the year, we're moving into 2024. It's an election year. The Federal Reserve tends to play it pretty cautiously during an election year, not to tilt the election one way or the other, recession, boom time, whatever. So we'll see if the Fed's going to change their approach to anything as we approach an election year. A couple other quick hitters. I was reading this article today. They were saying that consumers are spending and getting rid of their excess savings. Now I ask you guys this. What in the hell is excess savings? Why don't you say savings? Why the word excess in there? Anyway, silly season. But the big news coming up next week, we'll have Powell at the Jackson Hole Economic Symposium. He's going to give a speech there. That speech is going to be one that's very closely watched to give any indication whatsoever of what's coming up next for the Fed, how they see this inflation fight going, what is happening with employment, and a whole bunch of other stuff coming up next week. Of course, we're going to bring that to you guys. Tomorrow's Friday. Hallelujah. We'll wrap this crazy week up for you guys. Tomorrow we're expecting way more data coming in. Well, maybe not way more. Some more data to leak in tomorrow. We should be getting the more inflation data. We'll see where it goes tomorrow. I mean, every day just seems to be a new adventure. We never know what in the hell we're going to get from beginning to end. So we'll see what surprises tomorrow brings, guys. I'll be here to give you guys the news you need. Until then, until tomorrow, my friends, take care. Thanks.